Very good morning from India and welcome to the next webinar in the Fintelekt Asian Bankers Association series on the cost of financial crime compliance in the Asia Pacific. As always, we are grateful to each and every one of you for sparing the time to join us. And let me introduce all our panelists to you today. So may I please request all the panelists to switch on their video and audio. Thank you. So let me introduce the panelists one by one, starting with Sharon Pamplona. She's Head of Financial Crime and MLRO of ANZ in Hong Kong. She's a career banker with many years of experience in AML compliance in the Philippines, Cambodia, and now in Hong Kong. Welcome to the webinar, Sharon. Next, we have Rika. Sorry. Next, we have Rika Astari. She's an AML CTF compliance expert and consultant based in Jakarta. She has worked previously with ANZ, with the Indonesian banks, and until recently, she was senior compliance and operational risk specialist at UBS. Welcome also, Rika, to the webinar.
Thank you, Arpita, and hi, everyone.
I don't see David Haynes and David Zhuo. Please, can I request you to switch on your audio and video. So let me introduce, we have two Davids on the call today. David Haynes is the Vice President, Asia Pacific from LexisNexis Risk Solutions. He's responsible for developing and bringing to market a suite of services for clients involved in compliance, AML, KYC screening, and fraud and identity management. And we also have David Zhuo, Market Planner from LexisNexis Risk Solutions, who specialized in trade compliance and AML CTF. He translates regional requirements into solutions design and provides industry best practices to fulfill regulatory guidelines. So welcome, David and David.
Hi, everyone. Good to see you today.
Good to see you too. So LexisNexis Risk Solutions is our knowledge partner for today's webinar, and they have been publishing the annual True Cost of Compliance study, which delves into a variety of parameters around compliance costs and brings in-depth year-on-year insights on that topic. So for today's webinar, what we'll do is that we'll begin with a presentation by David Zhuo on the main findings from the 2022 Asia Pacific edition of the TCOC, or the True Cost of Compliance study that was released a few days back. And then following the presentation, we will have a panel discussion in which I will ask our panelists, Sharon, Rika, and David Haynes, their views on dealing with new AML risks, screening challenges, talent management, impact of the pandemic, and other aspects related to compliance costs. You can see David Haynes online. Welcome to the webinar, David. Okay, so we will take questions from the audience towards the end, and a request to all of you to use the Q&A window for your questions so that we have them all in one place. We often receive a lot of questions in the chat, but then those tend to get lost in all of the messages. So please put your questions in the Q&A box. So without further ado, let me invite David Zhuo for his presentation, and then we can start the panel discussion after that. So can we have David's presentation, please?
Hello and welcome to this session where we are going to uncover the cost of financial crime compliance in Asia Pacific. It is my pleasure to share market insights that we have gathered from our global research survey conducted on an annual basis. I would like to walk you through what are the biggest components costing compliance operations, how financial crimes are evolving, the impact that it has on businesses, and lastly, what Asia Pacific organizations are doing to tackle the rising cost of financial crime and compliance. Hi, my name is David Zhuo, Market Planner for Financial Crime and Compliance here in LexisNexis Risk Solutions. For those who don't know me yet, I would like to give a quick introduction about myself. In the last 10 years, I've been in the risk and compliance domain. I had the opportunity to work with more than 100 clients in APAC, understanding their needs around financial crime regulations and making recommendations on how they can refine their compliance policies and procedures. Before we move forward with these presentations, I would like to highlight this is for information purpose. It should not be regarded as a legal advice. The opinions shared today may not reflect those of LexisNexis Risk Solutions. So who is LexisNexis Risk Solutions? We are one of the world's largest global providers for compliance solutions. In the recent merger with Acuity, we are able to comply and complement our solutions in KYC due diligence, enhanced due diligence, payment screening, as well as trade compliance. In this way, we are able to provide an end-to-end compliance solutions to our clients. As we witness businesses go through digital transformation, fraud and identity solutions can help you identify and mitigate digital risks. We are also seeing a demand for payments efficiency solutions, where there is a need to validate payments data quickly so as to facilitate in the straight-through processing. Every year, we set out to understand what are the drivers and influencing factors that impact financial crime and compliance. We break down the survey segments into cost, time, and this year, what is the impact of COVID on compliance operations? For your information, LexisNexis Risk Solutions was not identified as a sponsor so as to reduce the potential brand bias as respondents give their opinions. At the end of our research survey, we have found 5 key findings. This includes the impacts of compliance and organizations' KYC operations, and we would like to draw a comparison between firms who spend more on technology versus less on technology. So this year alone, the total cost of financial crime and compliance is projected to be $50 billion. This is the first key finding we have found from our survey. As we break down the numbers, we are seeing banks taking up the lion's share of the cost. This is followed by investment firms and insurance firms. China and Japan tops the list when it comes to contributing to the overall cost to APAC. This is because they have thousands of financial institutes. And as for India, we know that it is one of the largest economies in the world. But since the country has half the numbers of financial institutes when compared to Japan, they come in third on the list. Now, I'd like to change a perspective to look at the cost of spending per financial firm. And on average, each firm is spending $11.3 million. And we look at Japan alone, it tops the list, doubling the cost to $24.5 million. When we look at the distribution of the compliance costs, 31% is contributed by employees' salary. If we factor in employee training, it takes up 50% of the overall compliance operations costs. Our respondents has indicated that the top external factor that's driving up the cost is due to the increasing geopolitical risk. As you know, since the invasion of Ukraine, the number of sanctions entities have increased more than 90% when compared to the same period of time 1 year ago. So this has been proven that it is a challenge for financial firms and they are spending more to mitigate the risk. So we also seen the increased AML regulations as well as the changing criminal threats. So this brings us to our second finding, where financial firms are facing a rise in digital payments as well as cryptocurrency risks. Criminals are using third parties to conceal their proceeds of trafficking and performing their predicate crimes. We have asked our respondents which sectors pose the highest exposures to financial crime, and e-commerce and retail merchants came out on top. This is because of COVID has forced people to stay at home for most of the time, and it has become a popular way of consumer spending. Criminals has cashed in on this opportunity where they make legitimate and illegal transactions to hide their tracks. And our respondents have feedback that some of the legal and accounting firms lend their support in setting up shell companies. So the movement of large illicit funds can be perceived as business as usual. Over the past 24 months, banks and investment firms, they have experienced an increase in the number of financial crimes. It is worth highlighting that banks has more exposure to trade-based money laundering. And for investment firms, they face challenges in identifying offshore companies, which may have complex corporate structures. We saw the financial crime trend evolve in the last 12 months. And in this instance, money mule risk accelerated to the top of the list. One key reason is because organizations are still using traditional methods of identifying money mules, but criminals, they have changed their tactics and tools for their money laundering schemes. This has a cascading effect on other divisions in the organizations. One of the biggest impacts when compliance screening is not performed effectively is a delay in accounts onboarding. Organizations have to use a mix of data sets and technologies to accelerate this onboarding process. Especially for business data, it is highly sought after because it is required to understand who are the company owners, what are the relationships, and the risk factors when establishing this business relationship with the corporates. It is worth noting that investment firms, they are citing a higher challenge in identification of politically exposed persons as well as sanctions entities. This is because since many firms are still using manual lookup tools to perform their onboarding and compliance screening. A lot of our respondents has indicated that to obtain a complete view of the business entity proves to be highly challenging. This is due to the broadness and the availability of the business data. Again, for investment firms, they have indicating a challenge in keeping up with the audit trail because of manual reviews and approvals that go into this KYC due diligence. We have seen that the increase in financial crimes, the changing regulations, and the impact it has on the productivity of KYC onboarding. In the key finding number 4, APAC firms has indicated that they expect 9 to 10% increase in the alerts this year, and this will result in more time needed for alert remediation. It goes without saying that delays in customer onboarding will have a negative impact on customer satisfaction and thus affecting the overall business revenue. The COVID-19 pandemic has made the situation even worse, where employees were forced to work remotely, and for countries and companies, who have a strict data privacy rules. This means that the impact on their productivity is amplified. To put some numbers into perspective, for the onboarding of foreign corporates, it is the most time-consuming for APAC organizations. Employees spend on average 55 hours to onboard one corporate account. In the event where alerts are generated, AML transaction monitoring alerts takes the most time for employees to complete their investigation and closure. In fact, it takes 32 hours for each AML transaction alerts. In comparison to the second on the list, sanctions alerts, which takes 16 hours. In the fifth and last finding, businesses are showing us hope in the path to getting through tough times. Organizations who allocate more spending on technology experience lesser severe impacts to the cost and compliance operations. For large firms, the overall cost of compliance stands at 18 million on average, but the cost lowers to 16.7 million when more investments is made on technology. We learn from businesses that taking a multi-layer approach is necessary as financial crime evolves due to a digital transformation. A combination of factors such as COVID-19 pandemic, digital crime, and increasing regulatory pressures are forcing organizations to be on their toes and be prepared for changing financial crimes in the future. Skilled compliance professionals continue to be in demand as they are needed to tackle complexity in risk mitigation. And having robust technologies and accurate data will definitely be useful to complete a comprehensive compliance program.
Thank you, David, for that presentation. We will ask you to join us back during the final Q&A session, and we can take any questions for you at that time. So let's now start with the panel discussion. Can I please request Rika and Sharon to come back online? Rika? Great. Okay, thank you. So we saw in the presentation that employee salaries and training makes up for 50% of the compliance operations cost. And another finding is that there is a huge demand for more experienced professionals, especially to address the increasing complexity of due diligence and screening and other tasks. So Rika, can we start with you? You worked with large banks as well as now you're involved with training. How do you think banks are dealing with this talent challenge, both in terms of hiring and training people to handle the complexities of compliance?
Okay, thank you for having me, and happy to answer this first question, Arpita. So my takes to deal with challenging sourcing on the right talent for AML compliance are, first, I think it's not only about recruiting and training, but we really need to develop ourselves and our team to have a roll up your sleeves attitudes and hands-on attitude inside our organization. It means that as a leader, we have to be willing to teach our team and to show them the efficient way to do things, and to share our knowledge, experiences, and insights to our team, and encourage and foster fresh and innovative ideas from our team in order to find an efficient way to deliver the best output for our compliance organization. And the second thing, I think we have to leverage the use of emerging and existing technology as an innovative solutions to meet AML/CTF obligations. For example, the use of responsible face recognition technology to do CDD in order to secure customer access to financial services. rather than using like customer service. And maybe another use case is the use of robotic process at automation for redundant process of operation like customer screening. And another thing that we can also use the machine learning to reduce false positive for our IML CDF transaction monitoring process. So on top of hiring and retaining and training, of course, these two ways are were to be taken as steps inside our organization.
Right. Thank you. Sharon, is that the same for your institution? You also have the advantage of working in several countries in APAC. Is this talent crunch a common phenomenon? How are banks dealing with it?
Yes, Arpita, thank you. And Rika was spot on when she mentioned about training your staff and then leveraging on technology. For me, I have a different approach on how I'm going to answer this question, because I remember a while back when I first started my career within financial crime. To be perfectly honest, I didn't have that background. They hired me because I distinctly remember this, because they needed my expertise in people management. So it was only then when I started, looking at the cases, the whole financial crime, AML sanctions and all of that. And then I realized, this is actually the career that I never knew I wanted. So while I was managing the team, I was also learning, building my career in financial crime. And that's one thing that I wanted to discuss is the financial institution providing opportunities to people who might not have that strong background is very important. Like I said, when I came, I didn't have that background, but they invested in me. I had to undergo training. I was exposed to different jurisdictions like Cambodia, Indonesia, China, and all of that. So they really made an investment, and I feel strongly that this is the career that I want to continue pursuing. So how we can work things out with our current environment, wherein we don't really have that luxury anymore, because it's very the environment is evolving rapidly, and as much as we want to, of course, we will still be providing training opportunities for our staff, but I guess what we need to do is to look ahead, or look forward. What are the different pool of talents that we currently have right now? We can do secondments, we can do training, for instance, KYC staff doing secondments with a financial crime team. So when there's an opportunity, when an opportunity comes that a role is available, then it's a lot easier for them to transition into the role. Well and good if it's readily available that we can find in the market, as David's presentation, that majority, the cost of compliance is, on the salary. So it is sometimes challenging, because if we're looking for experienced individuals, we're paying for their expertise, which actually makes sense. But we also need to look inside. Maybe we also have talents that may not have that vast experience, but the drive is there, and they're able to learn quickly and adapt to the ever-changing environment. So that's my take on this question of yours, Arpita.
Thank you, Sharon. And I think it's going to take a lot of innovative approaches to sort of look at this problem in the future. So coming to screening, it comes up time and again as an area requiring a large manpower as well as technology deployment. David, if I may turn to you, in your experience dealing with banks and financial institutions of various sizes across the globe, what are some of the main screening challenges, and have you seen any major changes over the last 2 to 3 years of the pandemic? If you can throw some light on that.
Yeah, sure. So I mean, the issues around screening, whether it be account screening or name screening, have not really changed, over the last sort of 10, 12 years plus. Largely banks previously were undergoing a very manual process when it came to name screening. I think, companies like ours, LexisNexis Risk Solutions, we provide technology solutions which are leveraging machine learning and AI more and more now, which is enabling banks to clear false positives and reduce the backlogs of onboarding customer lists, but by a huge degree. So I don't think the fundamental challenges have changed. I think banks, and this sort of ties into the previous question around costs, and I know the answers there were mainly around employment and staffing costs, which we'd expect to go up over time, but also investments in technology have gone up. And this is a direct correlation to the challenges in compliance. I think as institutions, we would expect our investment in good people and in good technology to increase to solve the evolving challenge. So again, the challenges are still there. We are seeing much higher volumes now than we have done in the past, with the switch over really to virtual banking, and not just for financial institutions, but we're also working with the e-commerce companies and alternative investment companies, cryptocurrency exchanges and payments providers, mobile wallets. All of those are going through the same challenge. It's mobile, there's more transactions happening, higher volumes, and the challenges are there, but the capabilities, the technology capabilities are really there to help solve those problems much more efficiently than they would have been solved sort of 10 years ago.
Right, that makes sense. So you mentioned, e-commerce and virtual assets and digital economy, and there have been drastic, changes to this during the pandemic. I personally think that the rate of evolution of AML risks has probably never been, higher than the last 2 to 3 years. And especially for traditional banks, this is probably leading to a very, very steep learning curve. So again, how are banks dealing with these new risks? And what are some of the mitigating controls that, you've had to put in place? So Sharon, would you like to take this one?
Sure, absolutely. So, with the pandemic, a lot of emerging risk and new typologies have emerged, and of course, banks are expected to deal with it at a rapid pace. Now, in terms, one thing that I could think of would be in terms of the KYC collection of documents. To be honest, in the beginning, I was not comfortable in accepting KYC documents electronically, for the simple reason that I've been accustomed to receiving hard copies of the document, and now we're put into this situation wherein we need to adapt it to make it easier for our customers. But the question is, what would give me confidence in accepting this new type of receiving of documents? So that's just one. And then the other, and it's good that we're getting guidance from both HKMA, our local regulator, as well as our from group on how we can effectively manage this. But that's just one aspect. The others that we have seen grown, like in terms of fraudulent activities, in terms of money laundering activities, on how they get more creative since the pandemic started. And like I said, we need to be ahead of the game, which proves to be very challenging for financial institutions. So we're talking about in the presentation earlier, there was made mention about trade-based money laundering. So of course it evolves during the pandemic, and then for us to be able to keep up and ensure that we do have the right tools and capabilities to do our job. That's really one of the challenges that's a reality, and something that we continue to work on. Now, what the financial institutions are doing is, of course, aside from keeping ourselves up to date on what exactly has been going on, also leveraging on technologies, and then making sure that we're based on the guidance that we have been getting from local regulators, and as well as from the entire group compliance, that we are equipped, and we were able to still be able to do our job, and making sure that the requirements are met without sacrificing, of course, the quality of the work that we have been doing. So that's it I'll stop right there unless there are additional questions on that.
Sure. Thank you. Rika, any further thoughts on that, on all these new evolving risks and how financial institutions should react to them?
I think, let's say, like if we are talking about evolving risks, we speak about Indonesia based on latest national risk assessment, that the development of technology directly impact to the increasing of AML/CTF risk, right? And if we talk about virtual asset, let's say like cryptocurrency, it's emerging risk happening in Indonesia in particular, right? And virtual asset like cryptocurrency is in Indonesia is prohibited as payment tool. However, government still accepts digital asset as commodity for investment. And regulators in managing AML/CTF risk of virtual assets have actually set regulatory framework based on FATF recommendation 15 on virtual asset. And of course, in industry, banks and financial institutions have to be extra cautious and conduct a risk-based approach when bank dealing with virtual asset service provider or related party. And steps to be taken, I think, are like we have to establish sufficient policy and procedure aligned with the development of technology, including managing and mitigating risk from the abuse of like virtual asset and other emerging technology and product and services, and conduct sufficient CDD or ADD to virtual asset service provider or related party, ensure they have legal basis to do business, has been licensed and under supervision of relevant regulator. So this is to prevent banks from facilitating the illegal investment and not reaching laws and regulation. If I talk about Indonesia environment, the SCP actually can only transact with individual. So client cannot be corporation. So when we are dealing with corporation that dealing with VASP and doing the transaction of virtual asset, I think bank has to do more due diligence and on this transaction. And then we have to identify and assess and mitigate AML risk from virtual asset abuse and doing continuous monitoring of customers, transaction and counterparty transactions to be able to identify unusual behavior of specific transaction. Bank also has to ensure and to update transaction monitoring scenario parameter in the AML system to be able to cater the ASP related transaction and conduct a risk assessment to reject or cancel or block, terminate business relationship with abusive or incompliant virtual account service provider and other emerging risks in AML area coming from the technology or new product service. That's my take.
I think I just add to that, if I may.
Sure.
So I mean, we, as both presenters and David mentioned, I mean, based on our recent study, you know, cryptocurrency and payments is a huge problem for banks. And I think the good news is we are starting to see watch lists emerge, and they are growing, you know, day by day. You know, cryptocurrency wallets, blacklisted IP addresses, and these are, you know, there's a big contributory network adding to this. And the good news is most of the mainstream cryptocurrency exchanges and wallet providers are very, very thorough when it comes to eKYC. I think gone are the days where everything associated with crypto is bad. I think we've flipped around now, and the majority of people using those wallets and those exchanges are using it legitimately. And like I said, there are lists emerging, and many of our clients are using them to identify and detect and share information if they see some kind of suspicious or fraudulent activity there.
Right. Thank you, David. So again, coming to another finding from the report, you know, 9 to 10% increase in alert volumes. I found that quite significant, and also the time taken to clear alerts. So, you know, if I can come back to Sharon, what do you think about this finding? Is this increase likely to be a spike due to the pandemic, or is that a trend, you know, that we are likely to keep seeing? And again, what impact is it likely to have on, you know, productivity and the ability to meet regulatory expectations and deadlines for the organization?
I think if we talk about the increase in alerts and its correlation to the pandemic, personally for me, since our clients are institutional, that I have not really seen a huge impact. It's still considered as BAU for us. So there wasn't really any major effect, like in terms of our submission of SDR to the JFIU. For the sanctions, however, it is a different case, and not necessarily because of the pandemic, but because of the geopolitical environment or issues that's been going on. So there may be an increase on alerts, but for us, since we do have the group solution that it is being managed and and then we do have the process and how we're taking care of it before it gets escalated to the respective in-country MLROs. I wouldn't really say that there was a major impact. Yes, it is true that there are new typologies, new risks that emerge, but again, it would have been a different situation if we have retail. If we had retail, I can only imagine the amount of volume that we'll be receiving. We had retail when I was in Cambodia, and even back then there wasn't any pandemic risk, but I was dealing with backlogs and alerts and cases that are going to me every single day. So yeah. Major difference if depends on also the client portfolio that you have.
Okay. David, any thoughts on this? What is your experience, based on other financial institutions?
Yeah, I mean, based on the data that we sort of have across the network, of course, transaction volumes have gone up a huge amount, and in turn, alert volumes have. I guess, going back to my previous answer, we have seen as well a sharp increase in financial institutions and other players leveraging technology to clear those much more effectively and quickly and efficiently. So, I think things are constantly improving. I think during the first quarter of the pandemic, we saw some panic and some frustration that there was certainly a delay. But certainly over the last 12 months, we've seen things improve significantly.
There's one other topic on, a single risk profile of customers, and we hear about the advantages that data and analytics can bring to this domain, especially in terms of, having a single risk profile. So practically, where do banks stand on this? And, are large and complex banks and financial institutions moving to that reality of having all the data under one roof? Rika, can we have your thoughts on this, and then maybe David can contribute?
Okay, I think it's challenging if we are talking about a single risk customer profile, because every bank has a different business models, right? Maybe they can also cater a lot of target markets and many segmentation and many types of product and service offered to customers. So it will depend on the business models and segmentation target of the bank. When we are dealing with banks that has a lot of segmentations, target markets, and product and service over to customers, and of course, it will require support from many front end, back end, and also even core banking systems. So it will make more complex to have a single risk customer profile. But in my experience, if this is the case, we can deal with this with several ways. Like first is we have to develop system to identify and monitor and gather all system and product and service into a single view customer profile, and record and keep all the demographic and account data coming from those systems, product and services to assist us to assess risk of customer in a comprehensive way. And we have to ensure that all single customer view data goes to our data warehouse and catered it in our customer due diligence, transaction monitoring, and also reporting system. And second, I think it's important for us still, even though we have a system to monitor, to identify, or to single risk customer profile, we still have to establish policy, procedure, and processes to promote single customer information file. We have to educate our frontline and also ensure that our system, front-end system, are able to cater to prevent multiple customer file, so we can manage the single customer file. And it's important for us to monitor and detect potential multiple customer information file and provide further actions to ensure that these multiple customer information file are not being used for smurfing, structuring, etc. So maybe we can have this multiple customer information file to be one of our parameter or scenario inside our transaction monitoring system. So we can also cater the risk of using of smurfing and structuring by using this multiple customer information file. That's maybe that I can share from my experience on this.
Sorry, David, your views on this?
Yeah, sure. So it is a, we have seen a trend whereby, banks obviously prefer to move to that single customer view. It just makes things so much more efficient and reduces friction massively for the end customer. I think we're moving away from the situation where data was siloed. Previously it was siloed in different departments of the bank. Each one had a different technology stack, and we've seen tremendous quick moves away from that over the last couple of years. I think data residency as well has had an impact here, especially in markets like India, with new laws and regulations being introduced, has really forced financial institutions to take a look at where data is stored, how it's stored, their technology they're leveraging, where their data centers are, and there's a renewed investment in that, which is pushing banks towards that single customer view, or at least being able to address that more effectively. I think as well, we've obviously seen a massive shift towards digital transformation, shift towards digital banking, and the introduction of neobanks and virtual banks. And those newer banks are in a very enviable position compared to some of the longer standing banks, because they're able to invest in that new technology and get that single customer view very, very quickly and very effectively. So again, it's an ongoing challenge, but again, we're making really good progress.
Yeah,
Yes,
can I
Sharon.
just also share my thoughts on that? Because David, you raised a very good point that we're moving away from the silos, and it's good that we've come a long way from how we are before. But there's also sometimes the challenge that, especially if you belong to a global bank, that there are certain jurisdictions that have privacy laws that we're not really allowed to share information, and there are also instances wherein a certain jurisdiction would have requirements that is not required in other countries. For instance, in Hong Kong, aside from the overall customer risk rating, we also need to have our tax evasion risk assessment, which is not necessarily required in other jurisdictions. So there would always be that manual aspect that we have to incorporate, which is a bit of a challenge if we're just going to be relying on one single customer profile. And not only that, there was one other point that I'd like to share, wherein if in terms of screening, wherein a customer would have like Sharon, Pamplona, and then in other jurisdictions it's Pamplona, Sharon, or the order or the letters are capitalized. So our screening should also be able to be smart enough to detect that we are referring to the to the same profile. Otherwise, it's also going to be a challenge wherein we have multiple profiles in different jurisdictions, but when it comes to screening, it is considered as two different individuals, whereas it is actually the same. So just wanted to add those points out there.
Yes, thank you, Sharon. There's one more, question that I have, and I'm going to post that to David before we move on to audience questions. The LexisNexis report also indicates that firms that invest in technology are the ones that actually reduce their, cost of compliance or compliance spending over time. But there are a lot of smaller institutions, that we interact with. And on this webinar, we have institutions of all sizes represented from various different countries. And they often have a very hard time justifying, technology spending internally and making a robust case for it. So what would be your advice to these institutions? How can they go about planning their technology journey and seeking the funds that they want?
I guess my advice would be, technology is always scalable. There is always an upfront cost, obviously, and there's an investment of time and assets and resources from the company or the bank in terms of their IT team's involvement. I guess really taking a long-term view is what's needed here. There's so many developments every month, and it really is essential to embark on the journey sooner rather than delaying things. And we work with some of the largest banks in the world, but also some very, very modest and smaller companies as well. And they usually start in a very small way, maybe implementing on a single use case. That may be customer onboarding, or it may be a payments use case, or a detail change use case. And pricing is usually based on API calls. So, if they're only making, $1 million a year, the price is quite modest. If they're making, $1 billion a year, obviously the price goes up, but it's usually in line with the success of their business. So I guess, pricing is generally scalable, and obviously embarking on that journey, that transformation journey sooner is really going to benefit in the long run.
Thank you. So at this point, can I ask David Zhuo also to join us back? And there are quite a few questions in the Q&A box. So let's go through those. So David, this is a question based on your presentation. This question is by Ramon. He says, David Zhuo gave a great explanation of financial crime in the region. Can any of the panelists speak about their projections regarding financial crime in the Philippines in the next 3 years? So do you have any specific findings for the Philippines, or a report that you plan to publish? You can answer that question.
I would say for Philippines, okay, looking at the economy, right, we are seeing that a lot of businesses are going digital. So there's a lot of talents in country. And in fact, a lot of multinational corporates are going into Philippines to look for technology talents, right, to support their software development, for their shared service centers and so on. So we are seeing similar trend as across the region. There will be more digital payments risks. There will be more interest around cryptocurrencies exchange, because to be honest, we are also seeing that people from all around the world, they may be using like VPNs or remote logins to pretend that they are in jurisdictions that allow for cryptocurrency sale, like Hong Kong or Singapore. In other regions, maybe it's not allowed, so they're trying their ways and means to trade in cryptocurrencies. So this means that it opens up a lot of opportunities for the financial criminals in the digital space to take over the accounts, right, of our legitimate customers, and then use them for money mules and for laundering their proceeds. So I would say, if there is any specific areas that you want to understand more in terms of Philippines, feel free to contact us. We do have a lot of local expertise there we can help you with.
Thank you. There's one other question specifically for David Haynes from Ganesh. It says fraudulent crypto movement through crypto exchanges. 98% are through exchanges resident in jurisdictions with weak AML CFT regimes. Curiously, banking regulators in US, India, Singapore, UK, etc. have strong opinions against cryptos as payment instruments. Your take on this?
So I guess what from our perspective, obviously we have seen an increase. We are working with a number of cryptocurrency exchanges around the world, and based on our experience, that they are taking a very proactive approach to compliance and AML and transaction and fraud monitoring. Of course, regulators have their legitimate concern. They need to protect citizens from fraudulent scams. But I guess we are seeing I think we're only going to see this increase. From my own personal perspective, I don't think we're going to see things change dramatically any time in the future. And to whoever asked the question, I'm sorry if I missed part of it, but please do reach out directly, and we can probably share some more detail offline.
Sharon, any thoughts from the Hong Kong regulatory perspective? The question says, regulators have strong opinions against cryptos and as payment instruments. So how has it been in Hong Kong?
I mean, I can't really comment on regulatory issues, unfortunately, but again, I'm very happy to have an offline discussion around it.
Sure. Yes, I wanted to bring in Sharon at this stage because Hong Kong Monetary Authority is seen as one of the major regulators in the region. So what has been the regulatory take on using of cryptos as payment instruments?
There has absolutely been a lot of circulars from the HKMA with regards to cryptocurrency and what are the do's and don'ts. And HKMA has also been very supportive in terms of RegTech. So there has been a lot of work that's being done. I may not have all the details, but definitely HKMA has been progressing on this department.
Okay. So Sharon, there's one question again for you. It's by Rose. Why is it difficult for an MSO with an up-to-date technology with a real-time screening system to open a bank in Hong Kong? What is the risk factor in this? You're on mute.
Sorry, Arpita, could you repeat that, please?
Sure. Why is it difficult for an MSO with an up-to-date technology with a real-time screening system to open a bank in Hong Kong? What is the risk factor in this?
I'm not really sure I can comment on that. It's not really my line. So I don't know if from my other co-panelists will be able to provide a response to that.
I think it's specific to Hong Kong, but if any of you want to add to that. Okay, no problem. Let's move to the next question. This is a question specific to the insurance industry. And maybe David, you can throw some light on this. The expense planned is very low compared to banks and much lower than investment firms. This seems to be because of the general perception that insurance is low AML risk area. However, considering the saving schemes, the risk should be about the same as in investment firms. What is the panelist's view on this?
I mean, from my perspective, and if the other David wants to jump in, please do. But I mean, I think it's widely regarded that the AML risk, I mean, insurance companies is somewhat lower than banks. We don't see anywhere near the volume of withdrawals or even investments in those policies. So the risk is certainly lower, but their approach to AML and their risk assessments is very thorough. And again, I think we've seen as digitalization has impacted the insurance company more and more, them take a much more proactive approach to screening. And certainly, I think we've seen an increase in suspicious transaction reports as well from the insurance companies over the last couple of years. But I guess from my perspective, and based on the companies we work with, it's not as significant as it would be in the banking space.
Okay. David Zhuo, do you have anything to add to this?
Yeah, just taking a step back in terms of the insurance industry, right? The AML risk that we are seeing is because how the insurance policies, some of them are being structured. So when a person or a company buys an insurance policy, they have a free look period, meaning to say they can provide all the information about the individual, the companies, and then have a commitment to purchase the policies. But then within 1 week or 2 weeks, they have the opportunity to surrender, right? And when these funds flows back to their bank accounts, this will be seen as like legitimate funds, right? Because the source is coming from surrendered insurance policies. So criminals does make use of this a bit of like a loophole to change their to launder their money into clean money, right? So I would say that yes, there's still ML risk in this insurance space. The regulators definitely will knock on their doors to see that how they are doing in terms of their policies and procedures. And when you look at the suspicious transaction reports, we do see reports coming from insurance industries as well.
Okay, thank you, David.
Arpita?
Sorry, yes.
Is it okay? Because there's really one interesting question here that I'd like to answer.
Sure.
Is that okay? Okay, so this is from Ganesh. He said compliance is seen as an impediment by business teams within financial institutions, a necessary evil, and unless there is a cultural change, the challenges will continue to be severe. So yes, so this is really quite interesting for me. And aside from the unnecessary evil that you mentioned, some of the comments that I received when as an MLRO, I'm not going to mention which jurisdiction, that so the relationship managers or the business managers no longer have time to look for customers because all they do is work on ongoing customer due diligence. So that's one. And then the other was MLROs are like gods. Their decisions cannot be what do you call this? You should always agree with their decision. And I get where they're coming from, but how I see it is, and once I received those comments, it was kind of funny for me, but at the same time, it was something that I took seriously because that's not how it's supposed to be seen. So it should always be as a partnership between business and compliance, and easier said than done. But like for me and my team, what we do is we really take the partnership seriously, wherein if there are things that that cannot be done, we explain it to the team, and then if there are some things that it's not really against the requirements and it's something that we could work on, we work with the business, because the mindset should always be we are helping one another. You're helping me do my job as financial crime or compliance by ensuring that all the requirements are being followed, and I'm helping you conduct business because we're a bank. That's expected from us. So there should always have that open communication. If it's non-negotiable, then that's fine. We just need to be able to explain to them. But if it's something that we could work on, then let's sit down. What are the resolutions, and how can we move forward from this? Always keep that open communication with the staff. Don't make them feel like, oh, when we say no, then there's nothing else that you can do. That's just my take on that question. But Ganesh, that was very interesting and very correct, with the exception of the unnecessary evil.
Thank you. I'm going to take one last question. We're almost out of time. So this question is by Mary Antoinette. In terms of advanced technologies, how can financial institutions and businesses adapt to digital onboarding? And will this indicate higher risks because of the convenience and increase of customer demand? Rika, can you answer that question? I believe there's a lot of digital onboarding taking place in Indonesia as well.
Yeah, digital in onboarding, especially in Indonesia market, I think it's quite interesting because customer really expect that the process of onboarding is simple and fast, and at the same time is easier for the customer. So that's the customer experience and customer expectation is very different and very high on the speed and on the simplification of the process inside a digital onboarding process. So, but that doesn't mean that we are stopping doing robust KYC or due diligence, right? Because we have to find a way to do the KYC and CDD to meet the regulatory expectation, and at the same time to ensure that the quality of clients that come to our banks are still high. So how we manage it is usually that during the onboarding process, we work with a third-party verification, like ID. We use digital ID, right? We can use digital ID, and doing a verification, online verification using face recognition, things like that to speed up. But at the same time, also using responsible technology, right, to ensure that the quality of client and we don't get any criminals coming into the bank. And after the onboarding process, we also have layers of process to monitor the customer transactions and doing a periodic review, event review to understand our clients. So we need to have layers of process during onboarding, not during onboarding, of course, because onboarding has to be fast, but after the onboarding process, we need to use multi-layer of controls to ensure that the quality of client that come to our bank are good.
Okay. Can I turn to David Haynes? Any last couple of minutes of response, and then we need to draw the curtains.
Yeah, I would just very, very quickly add to that. I mean, again, we have seen, not just in Indonesia, but across the entire region and globally, really, a huge increase in leveraging technology to speed up onboarding, reduce friction, and so on. I think the good news is now, you know, we're reducing the number of API calls and the number of technology providers that banks need to use. You know, only a few years ago, they would have had to go to multiple providers to go through that onboarding process, to verify an identity card, to validate the authenticity, to check the digital identity, and then there's the ongoing transaction monitoring. Nowadays, it's just a single API call. You can manage the onboarding, you can manage the ongoing transaction monitoring, the AML risk, and you can get all of that through single providers now. You know, much more cost effective than it used to be, much more simple to implement, and a much smaller burden on internal IT teams. So you know, we are really seeing that you know, that process improve.
Thank you. There's still a few questions pouring in, but we are now at the end of our allotted time. So actually, the topic is so vast and interesting that there's never going to be enough time, but we have to make a stop somewhere. And I think all our panelists have brought in very, very practical experiences. So thank you so much for your time, Sharon, Rika, David Haynes, and David Zhuo, and your contribution to this webinar. Thank you also to LexisNexis for being the knowledge partner today. And also a big shout out to Meg and Amador from the Asian Bankers Association. It's because of their continued support that we are able to, you know, take this series forward. Participants, again, thank you so much for being a lively and enthusiastic audience. So that's it. Wish you all a very great day and week ahead. And it's bye-bye from the Fintelekt team.
Bye. Thank you.
Thank you.
Bye, thank you,
everyone.
everyone.